Hello, ladies and gentlemen. I'm Joseph Novichko, Senior Trading Manager with GDM. Welcome to today's webinar. It is Friday, and as we mentioned the last time, when we took a look at one of our series of webinars, we've started with the basic steps into developing a trading plan. But the most important, what we've learned the previous time, was what the trading plan is in general, who needs that particular trading plan, and of course, most of all, what the trading plan does. So as we spoke a lot about this the last time, I will skip through the usual update on, or should I say, memory refreshment over what we spoke last time. So in general, I will just move forward to today's topic. It's the volatility, which is of course an integral part to any trader to have as an information what volatility is. In general, what volatility trading is, what does the volatility to traders, and of course, not at the last place, a few examples. If we have time, of course, we'll give you a few examples of a good volatility trading system. Simply, we're not focusing on trading systems yet, as we will do in our next series, next week. But rather today, I will give you more insights on what volatility actually means. And in front of your screens, you can follow closely on what exactly our headlines of today will be, so you can easily navigate through today's topic. In general, what you see in front of you is the breakdown on the questions that we will mainly work on. And of course, as a normal session, everyone would ask themselves, of course, those that have no idea what volatility means. And yet again, some traders might only think that they know what actually volatility is. But I've made it a separate topic because it's quite a big, it's a lot to talk about it, but I've shortened out about 5 pages of different information over volatility, questions that need to be answered, such as those are the general ones that we will be asking ourselves during the session. And most of all, when we face the market, there are always questions why the market does that move or the other move, or what exactly the market is up to. So we need to ask ourselves, what does actually volatility means? Well, in general, as a basic explanation what volatility is, this is basically a statistical measure of the dispersion of returns for a particular security or market index. You see, it doesn't really correspond at all at any kind of market movement, does it? However, volatility can be measured by using the standard deviation. Now, this is there are various indicators in the MT4 platform that you can use to measure that particular volatility that we speak about, or variance between returns from the same security or market index that we spoke above. Normally, the higher the volatility, the riskier the particular security or an instrument that you're trading is. So the more volatility you get, the more risk there is on the market. However, that doesn't necessarily mean that it's a bad thing. And at the end of today's session, we will have a look at why do traders care about volatility at all. Well, over here, there is a statistical graph on the year 2010, between 2010 and 2014, you can see how volatility actually, is on the most traded pair out there. This is the euro dollar. You can see on a year basis, every year the volatility is actually dropping. Well, we'll get to that. Meanwhile, a second type of an explanation of volatility is that it's a variable in options pricing formulas that's showing the extent to which the return on the underlying asset will fluctuate between now and the options expiration date. Now, volatility is basically normally used to trade options, okay, on the options market with, as I explained earlier, expiration dates and so on and so forth. However, that doesn't mean we cannot amplify it to something better for those that are actually trading the Forex market or the commodity market or the indices market. So volatility means everything on the market. It's not a good or a bad thing, but it's actually what we cannot trade without. In other words, volatility refers to the amount of uncertainty or risk regarding the degree and size of changes in the value of any particular instrument. Volatility, ladies and gentlemen, is expressed as a percentage coefficient with option pricing formulas arise out of the daily trading activities. You see, the way volatility is measured affects the value of the coefficient used in general. A higher volatility means that a security's value or an instrument's value, should we say, potentially can be spread out over a large range of values. So this is the more complex explanation in depth to the volatility meaning. A lower volatility, however, means that the security's value or the instrument's value does not fluctuate dramatically, but changes in value at a steady pace over a period of time. So this is the so-called steady trading or the trending market. There is no short-term fluctuations in price value. One measure of the relative volatility of a particular stock or any instrument or security to the market, there is of course a lot of formulas actually I wanted to present to you, but now that I think about it, it's going to be a bit too complex. Meanwhile, we're actually going to take a look at later on some technical indicators in the MT4 system that can actually help you trade the market by using those which measure volatility. So, talking about trading volatility, what is trading volatility? Or the so-called volatility trading? Because this is only a term that is used to describe trading the volatility of the price of an underlying instrument rather than the price itself. So you see, when we speak about euro-dollar as a pair, we don't really trade the price itself, but we actually trade the difference between the euro and the dollar in value. For example, one trader could actually trade the value of an equity index, but volatility trading typically means trading the expected future volatility of that index. All right. Any instrument, for example, whose price moves exhibits that price volatility. So simply, volatility trading is buying and selling the expected future volatility of that instrument. So I'm not referring as future as future says, I'm referring as to the time to come as a future. Let me say that one more time so you get it straight, that volatility trading is simply buying and selling the expected future volatility of, let's say, the euro-dollar. So if you want to say that the euro is going to go higher against the dollar, that means that you're trading that volatility for the future. Of course, all of that is better than predicting whether the price of any kind of instrument will move up or down. Volatility traders are concerned with how much movement in any direction will occur. This is what is important for the volatility traders. Now, short-term volatility traders are actually scalpers. I wouldn't even go to arbitrage trading because that's absolutely inappropriate, but I'm sure that you might even find this in the web, because the volatility in the correlation between different systems, that's how I put it, can bring you profits, and basically you have a glimpse into the future. But those which are more experienced on the market already know that, and those that are pretty basic on it, I would even disregard this if I'm you. Doesn't really matter what arbitrage traders do. It's the most important thing is that they don't usually get away with it. So how is volatility traded at all? The most common way to trade this volatility, as I mentioned earlier, is through options. The value of an option is affected by several factors, but an essential determinant of its value is the expected future volatility of that underlying instrument. Other things, of course, ladies and gentlemen, can be absolutely equal. Options struck on an equity index, for example, with higher expected volatility will be more valuable, in example, than options struck on an index expected to be less volatile. Therefore, options are quite good and simple way to gain exposure to volatility of any underlying asset. However, for those that are not really into options or any kind of anything different than Forex and commodities, the price of volatility is a very good information to them, because the value of a particular instrument can be attributed to several components, you see. By stripping these away, traders can imply let's say an unusual volatility level that a particular instrument picks a value that equates to. All right. It's basically everything is down to formulas, but all of that I'm saying so far is what you gain from using an automated system, for example, that trades for you, which is actually based on volatility indicators. I will get to that when we speak about the effect on Forex traders of the volatility itself. But before that, when we speak about price of the volatility, traders can compare this realized level of volatility with the current implied level as seen in the Forex market. However, there is a crucial difference here. The implied volatility level refers to the annualized volatility that is expected over the life of any Forex account. In other words, it is forward-looking and reflects all traders that are currently best estimated of future realized volatility will be. So you see, what you're actually trading is the volatility, not the price itself. And those entry levels as prices are only levels, as the volatility as a level as well. So the effect, as we mentioned, of the volatility over forex traders in today's market is it's quite great. Simply, I'll just refer to as we are pretty much fixed on day-to-day trading. Some are actually fixed on annual trading, and some of the traders and investors are fixed to a longer-term trading. So short-term volatility doesn't really mean anything for them. But for us, day traders, this is pretty much what we're looking for every day, to have it on the market. Otherwise, it will be very difficult, and not difficult, but it will take quite a bit of time to make good profits on the market. So for those of us, I would refer that trade the Forex market with the usage, for those that are using expert advisors or trend following strategies, they have gotten significantly less trades or any particular signal from the expert advisors on their systems. Why is that? Or why we may find that strategies which worked well previously are underperforming on or under trading? Well, this is something that I've mentioned many months. Actually, I never stopped mentioning it. Quite simply put, the fundamentals are shifting, which means any underlying asset which gets its value from the volatility, from the future volatility, and the expectation of that future volatility is dropping as a level. And as you can see here in this graph, from 2010 to 2014, the volatility actually dropped significantly 2 times in value when you compare it from 2011. Why is that? And why is that important? Because the lowest, we have the lowest volatility in about 10 years if you compare to previous years back before 2010. Currency volatility, ladies and gentlemen, continues to hover at levels that are not seen in over 10 years. So falling to its lowest level in more than 10 years in the second quarter of last year, I will put it, because the graphic here that you see down on your right corner is up to 2014. We're currently, of course, measuring the 2015 volatility, so the new graph will be established somewhere in, I believe, March or April next year, when the calculations are finished. And of course, somewhere at the end of the financial year, which we usually put it. So the lowest levels in more than 10 years. This can be attributed to rising geopolitical risk and downside risk to global growth. You can see what is actually happening around the world's financial crisis since 2006. Global oversupply of oil, for example, wars, geopolitical turmoil, as we also mentioned, political uncertainty in some countries. So basically, markets remain more data dependent rather than technically and more, mathematically based, should we say. So basically, it all means that we get higher volatility when somebody say something, and until that time comes, nothing really happens on the market, because everyone is afraid to trade anything without having up-to-date information on the current situation. Speaking of the euro dollar, for example, we see quite low levels for the past few weeks. It's mainly because of Greece. Whatever is actually going to happen, the dollar is still going to be stronger than the euro. So parity of this pair of these two currencies is is not, of course, out of the balcony. It's quite possible that we might be able to see that until the end of the year because of the strengthening US dollar on the back of the interest rate increase in US the first time since 2006. Speaking of which, why do we need that volatility? Well, let's have a few good examples here from an investor point of view at various volatility indices due to following main reasons, like higher volatility means more risk and also more opportunities. So you see, volatility is not necessarily a bad thing when you speak about higher risk, but higher risk brings higher profit potential, which means you have to be on the right side of the market. And that is why we're dealing with the whole structure of the trading plan that you need to develop for yourself, is basically because the risk that volatility brings to the market, by knowing what it is, combining it in a great, working, successful trading plan will get you on the right side of the market, or at least if you just go out of the path, you will know how to get back into it in order to avoid making mistakes. That is from the risk side of the volatility. But the opportunities that the volatility brings is for higher profits. Also, markets tend to fluctuate more and by a larger extent, especially on those announcements that I mentioned. I suppose in about 7 minutes we will have the numbers from US on the CPI. So I don't believe I'll be able to follow that with you, as we're into the topic quite well at the moment. But have a look, for those that are just coming on the market, is why I'm mentioning this, is take a look at the market just a few minutes before the news are released. You will see how the volatility will drop to its lowest. The market will be muted right at the first second of the market news release, and then you will see how the volatility will jump to its largest level, and it will keep climbing gradually until it comes down. And it usually happens after the first 4 hours of that release. Now, why I'm saying the first 4 hours? I'm saying it to remind those traders that are right now, right here on this webinar with me, they will remember when I mentioned last month about news trading from a technical standpoint and market pricing. But enough examples. Also, I am bound to mention, for those that are using robots to trade, algorithms. Most of the successful algorithms out there actually work only with low volatility, while other particular robots need high volatility to trade. So it really depends on the algorithm. You can't really have it both ways. If you're not a manual trader, of course. Risk management techniques need to be adjusted based on the changes in the market volatility as well. And of course, not at the last place, the higher volatility introduces more emotional stress for any particular trader. In a higher volatility environment, historical correlations between various currencies, ladies and gentlemen, tend to experience short-term deviations. So basically, those short-term volatilities can be brought, as I mentioned, by large announcement, something to happen, geopolitical or a natural disaster or whatever it is that actually brings higher volatility on the market, can actually disrupt all technical trading for some time, of course. not longer than 4 hours. Sometimes it's even less, but saying not longer because this is by far the longest period of time any kind of trend caused by announcement and high volatility lasts. This is where I measured it. If somebody measures something different, of course, I would very much like to know that. So there is also, as I mentioned, a way to measure those ranges on the MT4 platform. This is the average true range indicator. I'm not going to show you anything right now, but when we start connecting the dots at the end of August, when will be the last two sessions, part 1 and part 2, we will have a look at the live charts. We will implement all of what we are speaking about right now, and we will cover it in 2 separate sessions because we will have to remind ourselves from the beginning until the end what we're actually doing and why we're doing it. But having this sensitive information that I'm giving you each time on these sessions, that is for you to understand how to make that trading plan in the future, because a template, I can give you a template, but you can't really use it as a raw material. You need to work and modify it for yourself. Of course, the structure is the most important piece of information that you need to build this particular trading plan. So the average true range indicator stands above most others when it comes to measuring a volatility, or the also called ATR. For those that are using similar to the ATR, you can actually recognize the RSI, the parabolic support and resistance, and of course the ADX indicator. All of this, it measures volatility. So up until now, you have probably not even heard about that all of these are measuring volatility. So when we speak about the relative strength index, now we're only looking at overbought and oversold conditions when the so-called price will reach, but it's not the price, it's the volatility. So when it actually reaches the top of the mountain, the market loses that volatility and starts reversing down. So you see, I suppose it makes a lot of difference to your previous questions when you were asking what it measures. When I tell you that it measures volatility, you are followed by so many other questions. Why does it measure volatility? Because everything measures volatility. It's the volatility level that you trade, not the price itself. So a few more details about the ATR. It's a default indicator on the MT4, which appears as a single line below your charts. That's it, nothing more. So when we speak about lowest levels in 10 years of the volatility levels, what does that mean for price action in Forex exchange markets over recent months? That suggests that currencies previously were thought of as very risky to trade, such as extremely volatile currencies like commodity currencies like the Australian dollar, the Great British Pound, sterling. Those have continued to perform well during times of geopolitical tension and rallying US Treasury markets. So you see, everything is connected to that. The only pair that still exhibits a clear correlation to traditional risk factors is the USD Japanese yen pair. Now this always gets attention of any investor and trader as a safe haven, like gold, for example. One conclusion, of course, for any investor and trader could be that the general lack of trends and the major 10 currencies will continue, of course, with the dollar rallying to its highest levels when the central bank is actually looking for rate increase, as we mentioned, the first is since a decade. This actually gives the focus to very few currency pairs that remain extremely volatile with large risk, but with more opportunities, appetite as well. And of course, the three main characters remain in the focus of any trader and investor. This is the Bank of England, the Federal Reserve, and the European Central Bank. I'm not even going to go to the BOJ or the Bank of Japan. It's simply because, as we mentioned, this particular currency gets a risk in a very different way. It's still seen as a safe haven when something bad is happening, let's say in Europe, and you have no opportunity to trade anything that you have used to trade, for example. I'm getting a few questions here, but please, ladies and gentlemen, I will attend to those questions after the session itself, because I simply want to focus on that, as we have a lot to talk about and we're about half the way through. So if I have the time, I will just answer those questions, or maybe some of them, because I can see there are quite a few. However, if you need to ask anything specific, so I'll mention it here. You can see the email down there, webinar@gdmfx.com, or go directly to the website. You can see the address on your bottom left corner. Directly go to the support department and they will get in touch with me if it is something that is concerning my department from a trading point of view. But if you need to be assisted into opening an account or any other thing, of course I will be able to direct you directly to the person that can take care of this. But go to the support department. They will find you the person that you need. Whatever question you might have. We have a direct telephone number as well if you want to get in touch with us right away. Meanwhile, we will have a look at the rest of today's topic, as we mentioned. Well, let me first mention that volatile markets are categorized extremely simply by sharp jumps in price, and volatility breakouts can be used to develop a system to take advantage of these particular type of actions. Of course, when we speak about volatility trading and particular systems that you might need to use, there are some type of categories that you need to take under consideration when making a system such as this. And if you're interested, of course, I'll be able to assist you on that, to point you to the right direction at least. The characters that these particular systems follow are that they spend a substantial amount of time on the market. So you see, they generate a high percentage of winning trades, but earn a small average profit per trade. And of course, they don't take advantage of any big moves. So they are actually limiting the risk by avoiding the large risks, the big moves, and when they're making trades, they're taking very small profit out of it to minimize those risks, as we mentioned earlier, because trading in a volatility can be extremely risky, but on the other hand, brings a lot of profit potential. So another thing that it's extremely good and exciting and very important is that when you trade with these kind of systems, they're actually extremely quick, short in time. So you see, you might be even scalping some positions or just leave them for an hour or so until the volatility, goes low. And of course, the most important, they're actually based on increasing volatility. Why I'm saying that is because there is a particular system that you can use. I will just hint a few details here on the particular indicators that you might want to use. There are some of those that I actually presented to you in our technical trading webinars a couple of months ago. We've been using the Parabolic support and resistance index. Also, we've been using the ADX in a combination. If you remember this, you will find out that this is a quite profitable system indeed. So basically, the Parabolic support and resistance index based trading systems are ideas that you might keep developing in time when the fundamentals start shifting in a different direction. I've noticed that every 6 months there is always something that you need to adjust to your trading system or trading strategy, if you want to put it this way. The Parabolic, however, is a very good tool, which was designed as support and reverse system, which means that a trader, while using the Parabolic, will always have either a long or short position on the market. Of course, that's obvious. But when the Parabolic generates a buy signal, for example, if you're using only the index, only that particular index, as I mentioned, if you're generating your signals from the Parabolic and you have a buy signal, for example, a rising series of dots will appear below current price. So every time you go long, the dots appear under your candlesticks. As of course the market moves higher, the dots are always rising as well. So the most important thing is that if you're using only the Parabolic, if the price gets close or touches your Parabolic dots, take your profits and wait for a new signal or a reversal, of course. And as I mentioned before, it's always good to use this particular indicator in trade after the second one is closed, or a few minutes before it closes, if you sense that there will be volatile move. For example, in most cases, however, on a increased volatility, it tends to fluctuate, like appearing a few dots up, then a few dots down. So you can only use it when the volatility is low or modest or moderate, if you want to put it this way. Well, this is also something that you can consider from a technical standpoint. However, what we spoke so far is in extreme importance to developing your trading plan, and how we will continue to see what will be actually traded, what's the next step into developing a successful trading plan. We will find out next Wednesday. For now, our session is at its end, And I would like to thank each and every one of you for joining us today. The time that we have at hand is quite limited. However, I will answer all of your questions in person at an email or a telephone call if you've left your details when registering for the webinar. In other words, if you have not done so, go to our support department. They will get in touch with me so we can speak in person. And of course, whatever questions you might have, you can throw everything at me and I'll do my best to help you for whatever case you have. Thank you very much for joining us. I'll see you next time. Don't forget, next Wednesday, same time, 12 GMT. Thank you very much. See you then. Bye-bye.